Bandhan Mutual Fund presents MF Corner.
Hello and welcome to the special edition of Mutual Fund Corner on YouTube edition on CNBC. Thanks so much for tuning in, and now we're going to be discussing something that is very exciting and more pertinent to today's day because we've seen the markets be very volatile. Now everyone is wondering, where should I invest my money, and should I actually stop my investments in mutual funds? Should I stop my SIP? All these questions you have in your mind, and all these questions is what we answer. Where are we going to be investing in mutual funds? Where is it that you should be looking at in such a volatile market? What should be your strategy? To talk about all of that today, we have Brijesh Dalmia of Dalmia World Private Limited joining in with us. Thank you so much, Brijesh, for joining in with us on the show. And you know, it's such a right time to talk about this because everyone you talk to around is like, oh, where do I invest? What do I do with my mutual fund? So Brijesh, let's start with that. What should we be looking at in the mutual fund side right now in such a volatile market? And also, let's just answer that question. Should one exit that mutual fund investment right now?
Thank you so much for being for inviting me for this show. And you see, markets will always be volatile. It is not very unusual. And mutual funds are the vehicle where you should not think about exiting just because markets are down 10 or 20%. If it is aligned with your goals and you have the proper asset allocation, I don't think there is any reason to exit mutual funds at this point of time. Not at all.
Okay, do not exit. That is the word that has clearly come in, that do not exit. There's no need to panic. There's no need to exit. But, you know, Brijesh, now at such a time then, how do different funds actually perform in this volatile market, right? Which is more exposed to risk and which is less exposed to risk as of now? And where should you invest in? Which is the ideal option to invest in such a volatile market?
You see, primarily there are three categories of funds, debt, hybrid, and equity. Of course, there are gold. So let's talk about debt, equity, and hybrid. In debt, it has nothing to do with the current market fall. It is a product where, you tend to get around 6 to 7% of returns, and it is not connected with equity market at all. The other thing is hybrid. And if you're investing in hybrid, it's a very good time to invest in hybrid funds because by category, they invest more when the markets are going down, and they sell when the markets are going up. So it's kind of a periodical rebalancing every day, every week, every month kind of thing. And the third category is equity. Now, anybody investing in equity should consider it for 3 years, 5 years, 10 years, and maybe more than that. So it is only the equity category which is hurt at this point of time. And if you have long-term time horizon, then you should not worry about it. Having said that, I think it's a good time to invest in balanced advantage funds and also invest in equity funds if your time horizon is 3 years and 5 years from today. Debt, as always, there is no change. It's for short term, for 1 year or 2 years if you want to have an emergency funds and funds that you need for some goals in the next 1 or 2 years. That is always there. There's no change in that.
Okay, so you did talk about debt funds as well. You did say balance advantage funds is something that one could look at the current scenario as well. So in terms of risk also, is that more protected as well, right? Debt funds, because obviously you don't have that volatility of the market coming into play. And right now with that interest rate cycle, does that make it more, protected to risk?
You mean to say debt funds?
Yeah.
You see, debt funds will have some kind of risk in a very extreme interest rate volatility scenario. But if the RBI is cutting 0.25% or 0.5%, it will impact you for 15 days and 30 days. It is not going to impact you the whole year. Your whole year return is not going to go negative. So that's why we say, of course, there is some risk, but debt funds are kind of protected from the equity market completely. They are only exposed to interest rate risk. And if you invest for 6 months and 1 year, that is broadly also taken into consideration by fund managers, and you don't generally slip into negative territory. So I think debt funds are very safe to invest for 6 months and 1 year. And even if you want to invest for a week or 15 days, overnight funds and liquid funds, we have not seen any negative return 99% of the time. So I think, one can consider these funds.
Okay, and, Brijesh, what should we be looking at? So given everything that you've said so far, then debt mutual funds and in equity mutual funds, like you were mentioning, balance advantage funds or any other kind, which is a better option currently? If the investor is starting to invest today, suppose, then what is the best option right now to look at?
The best remains the equity. So if you're investing for 5 years or 10 years, you are getting everything down at 15, 20, 25%. What else you are looking at? valuations keep going up and down. So market never trades at fair value. And so there will be times you will trade 5 points above the fair value. Sometimes you will trade 5 points below the fair value in terms of, for example, long-term average is 18, 19 PE of the stock market. Sometimes you will trade 23, sometimes you will trade 15. It will never be constant at 18. So right now the valuations have come down, maybe a little stressed, but then again, if you're investing for 5 years, 10 years, this is a good time to take exposure in large cap or flexi cap kind of fund. Small cap, mid cap, maybe you can go through SIP or maybe a scattered investment. But I think overall it's a very good time to invest in equity funds. Balanced advantage funds are again they're a fantastic product. Of course, the long-term returns in balanced advantage funds should not be as good as equity fund because a portion is always invested in debt. And debt will not beat equity over long-term period. So in the short term, balance can do well, but if you're looking for long-term, equity funds are the place to be.
Long-term equity funds are the place to be. And if anyone has a long-term view, these ups and downs are something that will pass off at one point of time, right, Brijesh? So I think, long-term goals is something that is interesting. Then you can obviously, take that bet coming in also. And such good valuations like Brijesh is mentioning is not something that you see every day. Brijesh, what if someone has a short-term goal? Then, maybe it's just the 1 to 2 year time period. Then what should they be looking at such a time, right? If they still want to invest?
So this is a very good question. And you see, a lot of panic in the market is because people wanted to get higher return for a period of 1 year and 2 years. So they went into direct stocks and also in equity mutual funds, which are down today. So that is not the right place to be. So if your goal is less than 1 year or 2 years, you should not go for equity funds because typically if you see the Indian stock market, the cycle is 3 years or 4 years where the returns can be negative. So only if your horizon is 3 to 5 years and above, you should consider equity-oriented product. If you invest in equity-oriented product before 3 to 5 years, of course, you will be into surprises some of the times like today. So if your goal is short-term, let's say 1 month or 6 months or 1 year, you should go for liquid funds, overnight funds, maybe ultra short-term fund. And there are several categories of debt funds, medium-term funds. So anything below 2 years, you should only park your funds into debt funds. Nothing equity. Yeah.
Okay. And what is the option that we should look at? Is it SIPs? Is it lump sum? And depending on the goal also, does that SIP or lump sum change? Like if it's a short-term goal, then another option, and a long-term goal, should they go for lump sum SIP? What is the view on this?
So this is a very interesting question and there's a lot of debate. But let me tell you this, that there is no conclusive evidence that lump sum or SIP is better than lump sum. People think that SIP gives higher returns. There's no conclusive data. SIP gives return with lower volatility because you're investing every month, so you don't feel the pinch of market downfall because you keep investing and averaging your units at a lower price. You see, if you start lump sum investment today and you look at the returns in 20 years, you will get fantastic returns and you will also get returns in SIP. But if you start SIP, when the markets are going up, lump sum will do better because you have invested the whole amount at one point of time. So the difference between lump sum and SIP is only that, it is based on your cash flow. If you have a bonus, if you have sold your property, you get lump sum. That money you should invest into lump sum in the market if your time horizon is 10, 20 years. But if you're not very sure, you can scatter that investment through systematic transfer plan over the next 6 months, 1 year or 2 years. SIP basically is for people who are salaried, who have a recurring monthly income or a rental income, where every month the money is flowing in their account and they have to invest in the market through systematic investment plan because they do not have a lump sum. So as far as long-term returns are concerned, SIP and lump sum will mostly give you similar returns, maybe a percentage points plus and minus over 10, 15 years as a category of investment. Some funds can have a difference. But the mode of investment is very much dependent upon the inflow of the investor and it is not dependent on the market.
Okay, Brijesh, thank you so much for joining in with us today on the show and explaining our viewers, what they should be doing in such a volatile market, what mutual funds can you look at, and what sort of investment can you be looking at. Short-term goals, long-term goals, explaining everything there. So thank you so much, Brijesh, for joining in with us. And with that, we'll wind down this edition of Mutual Fund YouTube edition. Thank you so much for tuning in.
Bandhan Mutual Fund presents MF Corner.